Hi, and welcome to the X22 Report Spotlight. Today we have a returning guest, Charles Hughes Smith. Charles is a financial writer, a book author. He's the creator and owner of charleshughesmith.blogspot.com and of2minds.com. And I am very happy to have Charles back on the X22 Report Spotlight. Charles, welcome back to the Spotlight.
Thank you, Dave. It's always my pleasure to be on your program.
Hey, it's always my pleasure to have you back on here. And I really enjoy talking with you. And I wanted to start off with the economy. I think this is on a lot of people's minds of what's happening since we have a new president now, and people are seeing very strange things in the economy where they might not have been watching this very closely in the past, because the first quarter of this year, I mean, of course, coming off of Obama, he pretty much told us that, he's handing off a strong economy to Trump. But the first quarter, we see GDP at 0.7%. The Fed is saying this is an anomaly. This is not what the economy is really doing. It's going to get a lot better as we move forward throughout this year. But then we see, retail, well, that's not doing very well. Housing, really not doing well. In your mind, how do you actually think the economy is doing? Has it improved? Is it getting worse? Is this an anomaly? What's your opinion on this whole thing?
I think the answer has to start from some sort of context. Like, what are we looking for when we, try to answer that question? Are we looking at GDP, unemployment? There's a lot of these usual sort of statistics, right, which are supposed to be measures of growth, right? And growth is supposed to be good, because without growth, then, the economy falls apart, right? But I think maybe just as important as so-called growth, it's income, right? It's earned income, it's wages and salaries. Like, are people getting more money? Is their purchasing power increasing, or is it decreasing? And I think the answer to your excellent question is the economy is not improving, because for 95% of the households, their incomes are actually declining in terms of their purchasing power, right? In other words, inflation is eating away at 3, 4, 5, 6, 7, 8%, depending on what you're looking at. But the actual earnings are either stagnant or actually declining. Like, people are making less money. So how can the economy be doing better if 95% of the people are earning less money, right? I don't think you can claim the economy is doing better. So then you have to ask, well, then why does it appear to be doing better? And of course, we all know the answer is people are borrowing money to fill the gap between their cost of living and their earnings.
So you think right now that people are, I guess what you're saying, they're using credit cards or maybe taking out loans on their homes just to get by today?
That seems to be the case, because the Fed, I think, just released some statistic that said consumer credit, which includes credit cards, auto loans, student loan debt, mortgages. The whole thing is 12.7 trillion. It's exceeded the previous bubble top. So clearly credit is increasing, and yet wages are stagnant. So why are people borrowing more money? And anecdotally, we hear stories of people taking a class at the local community college so they qualify for a student loan, which they then use to live on. And you can say, well, maybe that's not typical, but I think we have to ask, how come credit is rising and yet wages are stagnant or down? What's the credit being used for? And then you read statistics that a third of all households don't even have $500 saved up for an emergency. And you go, well, how do we reconcile these statistics? And the only answer is people are using credit to pay their bills.
It's funny, because on the corporate media, when they mention like credit and, that's growing and it's good because it's helping the economy, they make it seem like if debt is rising, that is helping. And that means the economy is strong. Do you see that as a positive, or do you see that as a negative?
I think we have to dig down a little bit and go, who's benefiting from this, and who's suffering from this, right? So when credit expands, of course, the businesses that are making the sales are benefiting, and then the government is benefiting because they're collecting sales tax and income tax and all the taxes that go with increasing sales and profits. But what about the person taking on the debt? And of course, that's what the media doesn't talk about. And so maybe we can go back and look at the global financial meltdown in 2008, 2009, right, which triggered a global recession, and then in response, governments borrowed more money and spent more money, right, fiscal stimulus, and then the central banks created money out of thin air and pumped it into the financial system, monetary stimulus. And the basic idea here in the Keynesian philosophy is to bring consumption forward, right? It's to make it so cheap and easy for you to borrow money that instead of waiting 5 years to buy a car, you'll go buy one right now. And instead of replacing your furniture, in 3 years, you're going to buy a new sofa now, And so what happens, though, of course, is eventually that the snake eats its tail, right? In other words, we run out of the future becomes now, and there's no more consumption to bring forward. Everybody that could afford a car and wanted a car already bought a car. Everybody that wanted a new bed bought a bed, And so that's what I see here when you mention retail and housing starting to falter is people have already they've maxed out their borrowing power, and because their incomes are stagnant, they no longer have the ability to borrow more money. Even at 1%, I mean, if you're tapped out and you most of your income's going to pay debt you already have, you can't go borrow more money, and so that's why the economy's starting to falter.
And I guess that's why they keep reaching further and further down into the subprime market to find additional people to bring them in and let them borrow, because they keep changing the calculation. They're saying, oh, this won't count on your credit score. And we can see just from the automobile industry, they're bringing in a lot of subprime people just to move the cars and get them out there. And we see the automobile industry, they're having a problem right now.
That's an excellent example, Dave, of the process. That it used to be you needed at least 600 on your credit score or something to be considered creditworthy, and from what I've read recently, that credit scores of 400 were good enough to get you a new car. So clearly, the problem here, is when you extend credit to marginal borrowers, and this is not just consumers, but also businesses, right? I mean, if you're going to loan to a company that's really highly leveraged already, that's got a ton of debt, that's a marginal loan too, So all this debt is to marginal borrowers. They're the first ones to default, right? Last ones on the credit engine and first ones off, right? Because of any kind of little blip in their income, then they default. And then it's like, well, then how do we deal with those losses? And of course, we've learned in the last 15 years and the crash, the bubble and crash that we've gone through in 2000, 2001, and then again in 2008, 2009, and here we are at the top of another credit bubble. What happens is the gains from loaning all that money were privatized, right? Like everybody that wrote all those and serviced all those student loans, that over $1 trillion, they've already pocketed their gains, right? Now, when the defaults start happening, then those are socialized, meaning they come back to the government, right? The government has to backstop all these losses, and so then the taxpayers are stuck with it. And so it looks like that seems to be what's looming ahead. And of course, that's a drag, right, on the whole economy, right? When the taxpayer has to pick up the tab, then it pressures government spending, and the government can't spend as much as people would like on services, because now it has to pick up the tab on all this defaulted debt.
You mentioned the student loan market and bubbles, and we know the student loan market, it's in the trillions, and you mentioned it before, where people are taking loans out just to live, and they're living on it. And what's very interesting about the student loan market is that when it first came out, it was a way to pay for college, where you didn't have the money, you went to college, and you got out of college and you got a job and you'd be able to pay back your student loan. But in the past, 8 years or so, the student loan market, that bubble is blowing up, and many individuals coming out of school, they can't find work, and they're living with their parents, they're getting part-time jobs. and they can't pay back their student loans. And, they go through these loan modifications where now it's tied to your income. So if you're making a, low income, they project it out over time, and that's what your payments are going to be. But now it seems like the situation's getting even worse, because there is a bill that has been submitted that if you are bankrupt and you can't find a job, you have no income coming in, you'll be able to wipe out your student loan. Before, you couldn't do that. Now you'll be able to. So my question to you is, what happens when this starts to happen, where they're just wiping out the student loan debt? Who picks up the tab? Who's responsible? Because it just doesn't disappear. Someone has to pay for it.
That's right, Dave. And that's an excellent point that's often missed in all the mainstream media and the financial media is, the losses. No one ever talks about the fact that the losses have to be absorbed somewhere. They don't just disappear into thin air. Somebody has to pay for that loss. And so the thing about the student loan racket, and I think we really should use the word racket, is because the original concept was private lenders would fund these student loans, right? And so the risk would be on them. And within the 8-year period you talked about, or the last decade, then the federal government changed the rules so that these are non-recourse loans, right? Meaning they can't be dissolved in bankruptcy. So now we start seeing this circle that's fraud, really. You can call it a racket, you can call it fraud. It's something like that, because the lender can't lose money, right? Because the government will backstop it and say, oh no, we're going to guarantee all student loans and you're going to get your money back. And so the lenders have a guaranteed profit. And then the students are trapped, at least until this bill you mentioned passes. They're trapped under this debt that they can't escape, right? And then the federal government backstops it. So where it used to be private lending, right? And I have a chart that I've posted many times on my site that shows the federal government's share or ownership of student loans skyrocketed from basically nothing to over $1 trillion now. So all that debt that private lenders profited from is now on the government's books. And so when 500 billion is written off or defaulted on out of that trillion, then it's the taxpayer who's going to take the loss, right? And so is that fair? And you go, clearly it's not. It's not fair. Like the risk should have been attributed to the lender, right? And so the lender made a loan that's risk-free, and now the government is picking up the tab, and the students are kind of caught in this no man's land at this point, right? And so it's I think it's an example of why our financial system is broken, right? Is that losses are privatized, gains are privatized, and then when the losses show up, those are socialized and handed back to the government.
That is true. And we can see, just from the student loan market, from the automobile market, from the housing market, from the stock market to the bond market, all of these are just gigantic bubbles waiting to just pop. And some of them are deflating right now. Like we see the housing market, where we see new construction sales, they've declined. Existing home sales, they declined. So is this free money that the central banks have been creating over time, has this actually helped the economy at all?
And let's look at housing. And so we now have housing prices are back up to where they were in much of the country to the 2007-8 bubble, right? And so that increase in housing value has certainly helped people who bought, at lower prices, but it's made it unaffordable for Gen X and Gen Y, right? In other words, people who are entering the housing market in their 20s and 30s, it's like housing on the left and right coast is really expensive, and so it's no longer affordable. So there's this generational imbalance or asymmetry, right? Those people who own their house free and clear or have a small mortgage, their wealth has risen, but then what about younger people? They've been priced out of the market. And so we can see how the monetary authorities they're caught in this sort of between a rock and a hard place, because if they let housing prices decline, then to where they're affordable again, well, then all the people holding their wealth in their house suffer a huge hit to their home equity, right? And so you can't have it both ways. In other words, if you're going to make housing unaffordable for young families, then it's going to roll over because no one can afford it, right? But if you let it fall, then suddenly you've got a reverse wealth effect, right? Where people are seeing their home equity decline. They're going to feel less like borrowing and spending money, right? Like I'm getting poorer, not richer, right? So you can't have it both ways, and so that's why we're seeing housing stagnate. Is there's nobody's left who can afford it, except foreign buyers, right? Coming in, fleeing capital controls and the problems in their home economies. They're rushing here to buy homes in North America, with cash. And so that's propping up the market in, Toronto and Vancouver and other markets for sure. So, but take that away, and who can afford housing in America?
So, do you think the housing market is rolling over now?
Well, at least anecdotally, I'm sure you're seeing stories like this too. That sales in really high-priced areas like Manhattan and San Francisco are declining by like 15-20%, right? Right. And so it seems like the pool of potential buyers must be shrinking because sales are declining by significant percentages. And so I suppose we should say that this is, of course, housing is always local, right? We can't judge the entire U.S. market on Manhattan or San Francisco, and it's still cheap in places like the Upper Midwest, right? You can still buy a home for $50,000, in a pretty nice small town. But then the problem is where's your job? Where's the employment? So, but yeah, I think we could sort of summarize this going back to your original question: is credit growth the measure of a healthy economy, or is it actually the measure of a stagnating economy in decline, where people are borrowing more money than they should just to buy overpriced assets like houses and just to keep their head above water?
Do you think everything the central bank has done since I guess it was 2008 up until this point in time, do you think this has actually improved the economy? Or do you think that they never fixed the problems and they just basically covered up everything that happened in 2008 and here we are in 2017?
Yeah, I think you're right, Dave. I think they just kind of papered it over because debt, all debt, right, public, private, corporate, has more or less doubled, in these 8 years. So we've taken on a huge amount of additional debt on all levels, and yet people's incomes have barely clicked up, if at all. In fact, for most people, their income has actually declined, because it's stagnated, and inflation has eaten away their purchasing power. So we actually have less money and more debt. Well, that's not a combination that's healthy, right? Because the debt just eats away at our future income, right? And basically all debt is borrowed from our future income. And so if our income is going down, then that's going to inhibit our ability to pay all that debt going forward. And so then defaults seem inevitable, right? In other words, and then there's losses. And then you've got the self-reinforcing cycle where if businesses, are making less money and selling less product and services, then they have to lay off people, right? And so then we can look ahead and go, wow, well, what happens when we finally get a real business cycle recession here and people are being laid off? Then who's going to borrow all this additional money to keep everything afloat? So to answer your question, I think the central banks have weakened the economy considerably by increasing the debt load, but they haven't been able to force businesses to trickle down all that new money that's flowing into the system down to wages and salaries, right? People. So the mechanism is broken. And in the past, it was assumed that it was like magic, right? Like in the 1960s or 70s, if sales went up and profits went up, well, then people's wages went up too, right? But now we're in this global oversupply of labor, and that's part of the negative consequence of globalization, right? Because now we're competing not just against other workers in our own states, but we're competing against everybody in the world, right? At least for tradable labor. In other words, labor that's producing goods and services that can be traded in the global economy. Like, in other words, getting a haircut, well, you can't outsource that, right? I mean, you can fly to China and get a haircut, but that's really expensive. So that's why the economist Michael Spence, that's why he was given the Nobel Prize, is he explored this idea that there's tradable labor and then there's untradable labor. So, for finding somebody to cut your hair or mow your lawn, well, that can't be outsourced. So those jobs are safe, right? But if you're working in a factory or you're working in a service industry that can be outsourced, then your job is at risk, right? So we have this huge oversupply of labor. And that's why wages around the world are generally stagnating, right? And at least in the developed countries. And so you've got basic supply and demand imbalance, right? The demand for labor is less than the supply of labor. And this is why, the whole college education, you've got to get a degree or else you're unemployable. It's tragic because you can get a degree, and unless it's a specific specialized degree that happens to be in demand, then you're still unemployable in a lot of cases, right? And so the central banks are simply working on this false assumption that if they just pump enough money into the financial system, more people are going to get jobs and wages are going to rise. And the last 8 years has proven that to be absolutely false. I mean, they've pumped in trillions of dollars and fiscal stimulus, monetary stimulus, credit's gone to the moon, and yet the unemployment rate has gone down, but the number of full-time workers is barely edged higher, in 8 years, and wages have stagnated for the bottom 95%. So they haven't gotten it right. In other words, what they thought would work didn't work.
So what do they do now?
Well, that's an excellent question. And it's kind of part of this larger debate about deflation and inflation. And some people feel that their only option is to start printing more money and distributing it directly to households. And this is part of the idea of this universal basic income, right? That if people can't make ends meet, well, the system is, people will revolt, right? They'll overthrow their government because they can't make their ends meet, right? This is what history suggests. So the government or the central banks can always just print more trillions and start distributing it to the households. For instance, every household gets $10,000 more a year, and that's one approach. And of course, the danger there is you're printing a ton of new money, but you're not creating any more goods and services. And so that leads to high inflation. And then you eventually end up like Venezuela, where, the Venezuelan currency, the bolivar, used to be 10 to the US dollar. Now it's 5,800 to the US dollar. So it basically, once inflation really starts taking hold, then it impoverishes everybody in the whole economy. So they're really a lot of people feel that the central banks really don't have a way out now. They can follow that idea of just printing money and distributing it to keep everybody afloat. But then eventually you're going to get inflation. Or they can let these all these asset bubbles pop, and then that decreases the wealth that people were counting on, right? All that home equity goes away, all that corporate equity and stocks goes away. So, and then the system collapses from deflation. So there doesn't seem to be a way out, and that's why people are concerned, that there is no easy way out now.
Do you think with Trump out there saying that he's going to be bringing manufacturing, he's going to be bringing jobs. I mean, he's making these deals. I mean, nothing really happened. He's just out there publicizing that, we're going to be bringing back jobs. We're going to be bringing back manufacturing. And, he lists, how many jobs that they promise. But how can this possibly happen in this economy? I mean, do you see this actually as a possibility?
Well, that's a great topic, Dave. And to answer, we have to look at automation and then the overhead costs of hiring people. And as we all know, in America, like our healthcare system's broken, right? It's the most expensive system in the world, and it's paid for in this sort of weird half government, half private way that basically means there's no competition, right? If you go to a hospital chain or an insurance, healthcare insurance, you can't even find what the price is.
Yeah, they don't even list it.
No, the price is all over the map. And then people always tell me, oh, well, when I say, well, going in for a minor surgery, like having your toenail cut or something is $8,000 or $12,000. And then people always write me, no, that's not what Medicare pays. They only pay $5,000. And so it's like, oh, great. So for 10 minutes, $5,000 is fair? Because it wasn't $12,000, and it's all like, hey, come on, this is a $50 operation, not right. $5,000. So that system is so broken, and so expensive that some of the burden eventually falls on the employers, right? And so then, as an employer, you go, well, I could afford to hire this person, but once I add on all that health care and Social Security and all the other stuff, it's like I can't make money. So if we don't fix healthcare, we can't fix our job market. That's a problem. And unless you're an employer, you don't know how much it actually costs, right? So like an employee of corporate America or the government, they might pay $120 or something as their share of their health plan, and they might have a copay of $15 or something. And if those click higher, they go, oh wow, my healthcare is going up. But the actual cost is more like $1,200 or $1,500 or $2,000 per household, right? And so those of us who are self-employed, we have to pay the real bill, and we know, my wife and I pay like over $1,300 for a stripped plan, no eye care, no dental, and a $50 copay. $500 copay for an operation, and this is considered, a good plan. It's like $20,000 for two people is a good plan, and of course, so that's part of the debate that we're not having in our country is we need to be explicit about how expensive this is and what we can do to really lower the cost, because you can't hire people anymore in America. It's just too expensive, not from their wage, but from healthcare. And then the tax system. And we all, many of us had hoped that Trump was really going to change the tax system, but he's not. Like every other politician, they kind of fool around with, well, we're going to lower this tax rate here and there. But the bottom line is there's still like something like 70,000 pages of tax code, 69,000 pages of which are all corporate tax breaks. So, unless we simplify the tax system and dramatically lower the cost of the whole tax system for not only for households but for companies, then it's cheaper and more profitable to play all these games, right? Like have your corporate profits funneled through Ireland or the Cayman Islands or whatever. And so we would need to radically simplify our tax system, and that would make it easier to hire people here for sure.
But it seems like government, they don't want to do any of this. They don't want to move on anything. To me, it seems like they're just happy the way it is. We'll just keep borrowing money. We'll just keep paying out. And to me, it feels like at this point, it feels like we need to maybe reset the entire system. Maybe we should let the asset bubbles just go, and you know what? We need to start over here.
I think that's what we've been discussing here is just living on the national credit card, like just everybody borrowing more money to keep afloat. Obviously, that's not really a healthy, sustainable system, right? And it creates a lot of inequality. That's another like negative outcome of this thing is is a lot of people are poorer, and the top echelon is much, much richer, right? Because the credit machine impoverishes everybody that had to borrow money, right? And it enriches everybody who owns the lending machine, right? So like if you and I could each borrow $1 billion from the Fed at 0.25%, like 1/4%, and then we can loan it out at 3%. Well, hey, we're going to pocket like $30 million a year for doing nothing. So that's the kind of power of leverage. Once the central banks enable financiers and corporations to borrow at almost nothing and then lend that money out or buy back their shares, then that it greatly enriches the very top of the wealth power pyramid. And then, as you say, that all that wealth buys democracy. And that democracy, of course, is in quotes, because we have a pay-to-play system, and that's been shown in various studies, right? That when politicians go through the motions of passing laws, the impact on the bottom 95% it just doesn't come into their calculation, because the bottom 95% don't fund their campaigns. They don't pay for the lobbyists and the rest of the machinery. So yeah, clearly we need a system reset, and it's just a question of what's going to force that reset.
One thing maybe it will come down to cryptocurrencies, because I mean they've been taking off. I mean, a lot of people are saying that they're in bubbles and they're going to be crashing, but it is a decentralized system where the central bank doesn't really have control of it, and we can see that many people really don't understand it. Many people are not in cryptocurrencies right now. What I'm looking at right now is that maybe this may be a way to force the government, the central bank, maybe get rid of the central bank, into doing what we want. Because, and I was discussing this with you in the pre-interview, cryptocurrency, this is not part of the Federal Reserve system. It's not a Federal Reserve note. And if employers start using this and they start paying people in cryptocurrency, and then people use this to pay for goods and they live off it and they never exchange it for dollars, it seems to me that, well, since we're not using their currency system, then this cannot be taxed. I mean, at least at this point. And this would put pressure on the government. It would put pressure on the central bank. I just wanted to get your take on this whole thing.
To start with your first question, as I understand it, and I'm no expert, I do use cryptocurrency. I do own a bit, and I've used it to pay people in other countries. I paid two software guys in Venezuela to translate one of my books into Spanish. And Bitcoin made the whole thing really easy. No wire transfers, no $35 fees, no filing any paper with the federal government to prove that I wasn't, dealing drugs or something. All that stuff just goes away. It's very easy to pay people with cryptocurrency, and you need a wallet and that kind of stuff. But it's becoming a lot easier. And so as I'm just an amateur, right? I'm not an expert in cryptocurrencies, but my understanding is the federal government considers Bitcoin and other cryptocurrencies a commodity. So it's kind of like a futures. It's like an option on copper, or it's an oil contract, or it's considered a commodity. So if you trade it and you make money, then you do have to report that. I think that's becoming clear. Like the federal government, demanded the records from one of the larger Bitcoin wallet companies here in the United States. And so we kind of see that coming. And I myself, I didn't trade Bitcoin as a speculator. I was buying it in order to pay people, right? But I ended up making like $800 because Bitcoin was going up, right? And so I decided to report it because I don't want any hassles with the federal government. And so but all of this is in flux. In other words, the US based companies that are wallets, where you can buy and sell Bitcoin or Ethereum or Dash, many of them are starting to report your sales, and so that you can report your gains. But to your point, Imagine if you were just getting your cryptocurrency as a payment from your employer or from somebody who's paying you for a service you did, and then you go buy stuff with it. Maybe you didn't have a gain, because you bought and sold it, in a few minutes. And so you don't have to report a gain because you didn't really have a gain. You were just using this currency. And I think you're onto something here, that it really bypasses the entire system. And what makes Bitcoin and other cryptocurrencies unique is it's not based on debt. And
True.
and so there's no interest due. And so that's the thing about the central banks, is they create money out of thin air, and then they buy a bond. And so there's an asset and a liability. But ultimately, somebody in the system is having to pay interest on that money. And so the cryptocurrencies, you can say, well, they have no intrinsic value. They're just a string of characters, right? True. But at least we don't pay interest on their existence. So that's already a positive. And as you pointed out, it's decentralized. And so I have this ongoing debate with a lot of my techie friends about whether the governments can really crush cryptocurrencies or totally control them. And a lot of people think, oh yeah, they can do it. The NSA tracks everything, and they know exactly how many Bitcoins you own and every transaction you ever did. And that may be true. I don't know. But the fact is that these cryptocurrencies are managed in a distributed fashion. So the blockchain is actually distributed over thousands of computers around the world. And so it's pretty tough to say I'm gonna control that whole system, right? I don't know if it's possible. And as to your question, maybe governments are going to separate into wise governments who are going to get on board and allow and enable cryptocurrencies to thrive in their economies, or they're going to try to suppress it. And I think if governments attempt to suppress it, I think they're going to be big time losers. They're going to lose the economic vitality that comes with the decentralized cryptocurrencies.
Where do you think everything is headed as we move throughout this year? Do you think anything will improve? Do you think the economy is going to enter a recession or depression? Where do you think everything is going?
I'll just share my personal opinion, and I'll try to explain what it's based on. It's funny, we've seen like this 8-year cycle. And you could start anywhere you want, and it's kind of a parlor game to choose the cycle beginnings and endings. But obviously, we had an enormous asset bubble in the late 90s, right? And then that was the .com boom and the start of the housing boom, and then that blew up in 2000, 2001, right? And then we had a deep recession. Then now, 8 years after that, after the government and central banks did all their stimulus and pump up credit, blah blah, then we get another bubble, and that bubble pops in 2008, 2009. Now we have the same response, right? The central banks and the central governments have borrowed trillions of dollars into existence to spend and pump into the financial system. And here we are at another bubble, right? Credit's in a bubble, housing's in a bubble, stocks are in a bubble, bonds are in a bubble. And a lot of people think cryptocurrencies are in a bubble. I disagree. I think they're barely getting started. But so all these bubbles exist, and people are not making any more money than they were 8 years ago. They're actually making less money. And so how is this going to end? Well, I think we're starting to see how it's going to end already. Like retail stores are closing by the apparently thousands, right? I mean, aren't those numbers like 1,200 stores, and dozens of once thriving retailers are going to go bankrupt? We're seeing housing starting to roll over, at least in the sense of sales are declining, suggesting that the pool of available buyers is shrinking. So there's no buying power left to push housing higher. And this is what happens when you've run a credit bubble to the end, right? You run out of creditworthy borrowers, then you tap the pool of marginal borrowers that we were talking about, subprime. And once you've exhausted that pool, there's nobody left. And so then what happens is sales plummet, which we see in retail, we see in autos and vehicles, and we see it in asset purchases. So if that process picks up speed, and it appears to be picking up speed, then it looks to me like a global recession is baked in. And we're starting to see signs that China's shadow banking system is starting to come apart at the seams, which a lot of people have expected for quite a while. And so, it's kind of like a story of extremes can always become more extreme, but that doesn't mean that they're sustainable or healthy, right? It just means that the day of reckoning's been pushed forward. And so it feels to me like the day of reckoning's been pushed forward for 8 years, and now it's finally coming apart at the seams. And so I think we are going to have a global recession. And the old tricks that they've run for 20 years, which is, lower interest rates and pump money into the financial system, those aren't going to work because they've already used those tools. The interest rates are already at zero or negative in much of the world. So, and what's the Fed going to do? Drop interest rates 0.25% and think that's going to save the economy? I mean, it's a joke. So we have to prepare for how are we going to survive a normal business cycle recession, which is overdue.
Charles, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work?
Please visit me at of2minds.com, and you can read sample chapters of my books and look at my archives, and stop by of2minds.com.
Charles, once again, thank you very much. I really appreciate you. Thank you.
Thank you, Dave.